consistency is run by a bunch of investment bankers, and their modus operandi.
Hello, this is Javier Sánchez de Cenzano, Director of Analysis for Morningstar in Spain. We've got today Chris Hermie, who is Portfolio Manager of Petercam Equities European Dividend Fund. Thanks, Chris, for joining us today.
It's my pleasure.
As I mentioned, Chris is the manager of this European Equities Fund. It is a fund that holds the Morningstar analyst rating of bronze, so our team of European analysts throughout Europe think that this is an above average proposition and a fund that is worth considering in the long term. Given your remit, Chris, it might be a good idea to start with how you see the European economy. How do you think we are heading, whether we are actually getting or heading towards that recovery that everyone seems to be talking about these days, and then we can move on to your portfolio, how you see equities.
But it's a very interesting question, in fact, because we have seen 2 years of very good equity performance in Europe, and we in fact are very constructive on European equities. If you look especially at the earnings picture, we have seen 2 years, 2012, 2013, where earnings expectations drifted down towards slightly negative. So the market is not expecting a lot on the earnings level even for this year. What we find specifically interesting now is that all these economic indicators like the PMIs or the leading ones are turning above 50. And that's a very interesting point, because typically when these indicators turn, you get a significant earnings recovery. That's also why we are very constructive on the European markets. And when you look at the earnings picture compared to the rest of the world, let's say European earnings are more or less 30% below the peak in 2007. US is already above that level, and Europe is still 25% below that level of 2007, which is a bit exceptional. And we would expect, if this PMI and economic data turns, that the earnings picture in Europe changes significantly, and we get significant positive earnings momentum in the European markets.
And considering that you run a European equity dividend fund, maybe you can talk us through in which part of the markets you see more potential, more upside potential, or more interesting opportunities?
But given that the market is now really focusing on earnings recovery stories and typically the cyclical names that do very well in this part of the cycle, we tend to look for cyclical exposed companies with huge earnings potential recovery. And to give you a few examples, a company like Saint-Gobain exposed a quarter to French construction, a quarter of the business is exposed to the US construction business. These businesses have a significant exposure to an economic recovery. If you just take a look at the economic or at the expectations for the earnings, you see that these companies easily get an earnings recovery of above 30% starting as of 2014. So these are typically companies that we look for, where we have a significant earnings recovery and still with a significant payout or an interesting payout of 50-60%. So there is an opportunity when the earnings recover to increase the dividend, and there is absolutely no risk that the dividend will be cut in these type of companies. This also means that for our type of strategies, that our beta in this part of the cycle increases as well. These cyclical names have typically a beta that is far above 1. These cyclical names, it's not exceptional that they have 1.5 or 1.8 as a beta. So this means that in the cycle our beta of the fund increases towards 1. And this also counters a bit the argument of a lot of people that dividend funds are perceived to be purely high defensive kind of products, which do not perform in these type of markets. I want to stress, and we are convinced, that given that we have this cyclical exposure with the beta trending towards 1, that we can keep track of the markets, which is in fact the target of this type of funds. You keep the markets, or you keep up with the market as much as possible when the market is very positive, and you show a significant downward cushion when the market is negative. So that's really the heart of this type of strategies.
Okay, so it sounds like you are adding risk to the portfolio on that cyclicality exposure. But if you look at it from the, let's say, core versus peripheral countries kind of way, we've seen a kind of dislocation between these two segments in the past few years. Do you think there are now interesting opportunities in peripherals? They kind of rallies. Which kind of sectors or companies are you favoring in that area?
Well, in fact, if you know with Petercam, we are a boutique that is bottom up. So we don't like to make big, or in our fund, we don't like to make big top-down calls, be it on regions or on specific periphery or core or whatever. We kept true to our process, which is trying to find companies that pay a dividend yield above the market average. Be it a company in Italy or in Spain, it doesn't really matter. To give you an example, we kept our holdings in Italian companies like Atlantia, the autoroute operators. We kept our holdings in Técnicas Reunidas in Spain, the oil service company, just because we thought there was some value. Técnicas has no debt, has a very strong balance sheet. Was attractive a year and a half ago because nobody looked at it. It was periphery, yes, but almost their entire business is out of Spain. So for me, it doesn't really matter if a company is trading in the periphery or not. It's about the business and about the value of the business, in fact.
Great, Chris. Thanks for joining us today. It's been really interesting to get your insight on the European equity market. I thank you all for watching, and please follow us on our Twitter and Facebook accounts. Thank you.
Is run by Hayes investment bankers, and their modus operandi